we will start study session 8. Broadly, we are going to discuss understanding the income statement, understanding the balance sheet, cash flow statements, and in the last, we are going to discuss the financial ratio analysis, that is called financial analysis techniques. Now, I will, in general, I will discuss what we are going to discuss. Income in accounting, we have 5 things. Assets, liabilities, capital, expense and income. There is no 6th thing out of this contest. Every accounting financials is dependent on these 5 alphabets. Assets, income, assets, liability and capital, we make balance sheet out of it. And income and expense, we make the profit and loss account, which is now renamed as income statement, and the statement of comprehensive income is the latest thing. Now, we will understand today what are the income statement, what is income, what is the definition of income, when we can record it, that is a revenue recognition standard we have to discuss, and we will discuss different formats of income statement, and we will come up how to calculate the earning per share. That is the most important thing for the company, because it tells the shareholder that how much each share is earning for the company. Then we will discuss in the next lecture balance sheet, cash flows and ratio analysis. What we are going to discuss in income statement is what are the components of the income statement. Generally expense and income, but what is the type, like sales less cost of sale, gross profit less expensive, tax, interest, income before interest, income after tax and interest. This format we will discuss. Revenue recognition. When we are going to recognize the revenue. For example, you saw a dream that tomorrow you will get a big project. So in the next day you are telling the accountant, okay, this project passed the entry and recognize the sale. Is it like that? Or there should be stringent criterions when you can recognize the sales. Means the sale is actually confirmed, reliable, and order is confirmed. Then what are the standard conditions we will discuss. Accrual accounting. There are 2 types of accounting. One is cash-based accounting, one is accrual-based accounting. Cash-based accounting is when you receive cash, you enter in your books. When you pay cash, you enter in the books. This is receipt and payment, which is not recommended by the accounting standards. We have to go for accrual based. Accrual based accounting says whenever you feel or realize that income is going to take place, you record it, irrespective that money is received or not. So don't link anything with the inflow and outflow. When you feel, when you recognize, when you foresee the income is to be generated or expense is to be incurred, you record in your books. This we will discuss in detail. Expense recognition, such as matching principles. Match your income against the expenses in the same period in which it incurred. This is the matching principle. Method of depreciations. What is depreciation? This is decrease in the value of fixed asset. Now there are 2 methods. One is straight line, one is reducing balance method, and the third is double depreciation method, which we will discuss. In fact, there are 32 methods of depreciation. Broadly, but standard based on the industry. Sum of digits is there, equivalent unit protection depreciation is there. But these are 2 most commonly used in our books, that is standard straight line and reducing balance. Accounting for depreciation means if there are 3 methods generally we know. First is LIFO, that is last in first out. Then FIFO, this is first in first out, and one is weighted average. This is we will discuss today. And amortization is like a depreciation, but this is for intangible assets. What are the intangible assets? The copyrights, patents, and anything that you can take it as in the domain of intangible asset, which cannot be touched, but it has the intellectual property and the value itself. So I will start my lecture now with detailed discussions. We will start our discussion from components of the income statement. Income statement equation is always revenue minus expenses is equal to net income. Revenue is a term which is broad term. In other languages, we don't differentiate between turnover, sales and revenue. But for our CFA curriculum, we should assume that revenue is a big term, which include the sales. So sale is a component of the revenue. In fact, for all trading income, we should use this word as revenue, not as sales. Revenue minus expenses is equal to net income. This is the basic formula to calculate the income statement. Our perspective here is not to understand that how to make income statement. Make it very clear. Don't try to be into debit and credit or the rules and regulation. No, it's a surface level knowledge for you. So once you become an analyst and you get the financials, you should know what is the format, what are the terms inside, and how they are routed from, and how you should take and start your analysis in terms of ratios and other things. The preparation of the financial statement is a work of an CA, CCA or a CPA. Where it finishes, the work of a CFA will start. So approach to take this topic should be analytical, understandable and comprehensive, right? So a firm can present its income statement into certain formats for internal reporting, but for external reporting, either you have to follow the gaps if you are in US, generally accepted accounting principles, and for rest of the world you have to apply the IFRS, that is International Financial Reporting Standards. Being a student of CFA, for example, you are based in US and you are analyzing one company which has one office in US and one is in Europe or in UK. They are following IFRS, you are following gaps. So it's not prudent, it's not, you can say, logical that you just take the figure of gap based and the IFRS and you compare them. Because there are certain treatments which are different for inventory. This is we will discuss in the next lecture, that what is the common differences that an analyst should know. First he will adjust back and make it either GAAP or either IFRS, and then start the analytical procedure. So, but as per standard, we have to show 2 years financial figures in our income statement or in all financials, 2010, 2009. So both year trend will be there as per standards. Now single step is all revenues and are grouped together and all expenses are grouped together. Just as a simple form of income statement for the maybe internal management who just want to see what revenues they have, what expenses they have. But the commonly used is the multi-step format, which include totals, subtotals like revenue, then net revenue, then cost of sales, opening stock, add purchases, less closing stock. Then you will have a subtotal of cost of sales. Then these totals will deduct, you will get the gross profit. This is multi-step format for the income statement, which is this one. You can see here revenue, cost of sales, then the subtotal, gross profit, selling, general administrative, depreciation. This is the operating profit. Now after operating profit, whatever interest we have to pay, we will pay. This is income before tax. Provision for income tax, and then income from continuing operations and income from discontinued operation. If your company don't have discontinued operation, no need to take this one. But if you have discontinued operation, by standard, by regulations, you have to show in your income statement that this is for the user. Suppose if you are an investor, I am a company, you have to advise a multi-millionaire to invest in my company. You are an analyst and you have some investor. If I don't show discontinued, means everything is fine, right? So it is a sort of misleading on a part of the company, that they are not showing that this year they had one plant in, say, Kenya, which they stopped. So for that, we have to show the continuing operation and we have to show the discontinued operations. How to show? It's very clear. This is not our work how to prepare it. But we should know as an analyst, as a base knowledge, that if the company has discontinued operation, it should show. Because while analyzing, if we come up with this information that they have some discontinued operation and they didn't show on the income statement, so it will be a threat to the integrity of the management. It will be a question. And we have to be very intensive in our analysis. We have to, like in audit, we know we have to go for a detailed testing of the transaction if we don't believe that the audit, the management is using integrated practices or ethical in their roles.
Red flag.
Red flag. If they don't show this. Now, we will discuss under the accrual method of accounting, revenue is recognized when earned, irrespective that we receive money or not. Suppose you are selling something and I am buying that good. We make a deal. Now the good ownership is transferred to me. So ideally, the same date when the deal is signed and the goods ownership has been transferred to me, then this is my item. I should immediately record in the books. Even I didn't pay for it. Maybe I will pay you 60 days credit, 90 days credit. Payment is irrespective from accrual account. Accrual accounting is different. It has no concern with the cash receipt or cash paid. Now revenue is recognized when earned and expenses are recognized under when incurred. When incurred, yani once we will do some expense, then we will record it. And not based on our estimation that this is, in next 2 months you will go for an engine overhaul of your car, so I will record it now. No need like that. So no consideration whether cash is received or not. This is very important. In multiple choice question you have to be very careful, because on this level he is going to check your concept of accrual based and cash based. If a firm receives cash before revenue recognition is complete, the firm reported as unearned revenue. What is unearned revenue? This is, for example, I took the money from you in advance. Now it's my liability. I am liable to give you the services. So unearned income is a liability, because we have 5 things in accounting, that is asset, liabilities, capital, expense and income. Now suppose salary. Is it asset, liability, capital, expense or income? This is how we have to start thinking. That what is asset, what is liability, what is capital. Being an analyst, you should know when you see the financials, you should know this is asset, this is liability, this is capital. So you can classify in your ratio analysis tool and other financial toolings, financial valuations. This is a basic thing that you should know. Unearned revenue is reported on the balance sheet as a liability. This is in case when we don't provide the services in advance, we receive the money. This is unearned, means we didn't earn it. This is unearned, it's a liability on us. Now, okay, let's continue our revenue recognition. For big companies, sometimes we are not sure about the revenue when it will come. For example, you are making a tower. This is on contract. You have main contractor, then you have a subcontractor, then you have a subcontractor, and you have a subcontractor. Right? This is how the big tower is going to develop. Now, how to record the revenue? Because revenue will come in stages. This tower will develop in stages. One, you can say, unprudent approach is that you keep spending the money, expense, and one day when it will build, then you start selling and then start recognizing that this is one flat sold, other sold, 3 sold. So 5 year, 10 year, you always report a loss because there is no income. And 10 years after when it is formed, then the 10th year is high profit because expense already you have recorded. So this is not giving you even trend of something, which is not a logical thing. We should, one method is called the percentage of completion method. Means if you complete 50%, you record 50% of income. This is how stage of completion means. If the 50% project is completed, then you record the 50% of the revenue as well. This is one method. Now, what is that method? We will discuss long-term contracts or contract accounting. 2 methods for the contract revenue recognition. One is percentage of completion method. What it says, when the project cost and the revenue can be reliably estimated, then we can use it. Sometimes the project revenue is not reliably estimated, then we cannot use this method. This method is only when we are reliable about the project cost, evaluation, money, revenues, and the percentage of the completion is made by total cost incurred to date divided by the total expected cost of the project. This I will do an example also. Just I am reading for you, so once you do the question, it will make very simple for you. That first thing is the project should be reliably estimated. The other is whatever revenue will be recognized, it will be based on cost percentages. Revenue will be based on the completion, and completion figure will come from the cost. Suppose total cost is 800. In year 1 we incur 400. So stage of completion is 50%. How? 400 divided by 800. That is 50%. So revenue should be 50%. If the total contract is 1000, so we should take 50% of that one. So 500 is the revenue for year 1. This is a simple way to understand. The other method is completed contract method. What is that? When the outcome of the project cannot be reliably measured or the project is short. Accordingly, revenue, expenses and profit are recognized only when the contract is complete. Because we cannot do anything. We are not sure about the flow of income, revenue, and cost is also not reliably estimated because of any factor. So under either method, if the loss is expected, the loss must be recognized immediately. This is the rule now, that any loss immediately you have to record. Now this is a question, it will clear our concept in terms of stage of completion. I will show you from here. There is a construction company, they have to build a ship, $1,000, and the estimated cost is $800. Cost is with you, this is the expense, and this is the revenue. There are 3 years is the completion time, that is 2005, 6, 7. Now cost is given to you in the question, that is first year how much? 400. Second year 300, third year is 100, and total cost is 800. First thing is, because we are talking about stage of completion method, simply divide this by this, by this by this, and this by this. When you divide 400 by 800, it will give you 50%, right? Means the revenue should also be 50% of what? The total price. What is the 50% of 1000? 500. So this is 500. 500 minus 400. 400 from where we get? This is given in the question. Just what we did, we make one ratio. Stage of completion. How we get it? Whatever is completed, we divide it with the total. So 400 divided by 800. That is how much is 50%. Same for this year and this year. You can see total 800 and the total revenue is 1000. If you divide 300 divided by 800, you will get the percentage. Same way, 100 divided by this, you will get the percentage. Okay? No confusions? This is stage of completion method. Seems to be a difficult, but it's very logical and...
It's very easy, but I remember I did a mistake on this when I was doing cubing.
Ah, okay. No issues, no worries about your past. Look about your bright future in that. Things are clear. If you learn the right way, you behave in the right way. This is the logic.
This was on the exam, these two differences.
So this is clear now? Now, under the completed contract method, revenue, expenses and profit are not recognized till the contract is complete.
So do they make provisions for it?
They have to make.
They have to make provisions, right?
Now, therefore, at the end of 2007, a report means in this question you have 2005, 6 and 7. So at the end of 2007, this company report this revenue and this cost and it will be a profit. They will not report anything in 2005 and 6. This method is rarely used. Mostly used is the stage of completion method, which is more logical, that you recognize your expense and the relative revenue in the first period.